Nirupa Shankar, the MD of Brigade Hotel Ventures, to discuss how the quarter has gone by, what's the outlook ahead, listening to what she had to say. My first question to you is going to be about, the RevPAR growth that has come in largely is driven by pricing. Just want to get more sense in terms of how the new supply that is going to come across for you, because you have a large pipeline lying ahead of you. How much more headroom do you think you have in terms of, going more towards the pricing growth? What is the outlook going forward?
Hi, Mahima. Really happy to be on your show and to be speaking with you. So yes, we have had a resilient quarter, all things considered. It's not been without its challenges, I would say.
Right.
But the good thing is we were able to show a 7% ADR growth and a 2% growth in occupancy. So the portfolio is quite stable from an occupancy perspective because it's at around 76%. But I'm really happy that despite the fact that, a lot of the foreign tourists or the foreign travelers could not make it into the country, we lost a bit of business there. We were able to displace that business with domestic demand and still increase the prices by about 7% on average for the portfolio. In terms of the new supply of hotels, see, I think the market has been, or rather the hospitality industry has been extremely resilient because we are so very dependent on all the global macroeconomic environment with people traveling. So there has been a decent amount of disruption, especially when it comes to, say, large MICE businesses. But despite that fact, I still think there's a lot of room for growth. According to me, when it comes to occupancy, for instance, portfolios or hotels should stabilize in the mid 80s. That's a very healthy number. And I would say at least 5 out of our 9 properties have average occupancies in their 80s. So there is room for improvement with the other 4 hotels. And I think a mid 80s percentage is good from an occupancy perspective. From an ADR perspective, of course, it's very demand driven. When the demand is strong, when there's a lot of strong MICE, then of course you can always increase your rates. When there's more foreign travelers, again, they are usually paying higher rates. But I would say there is always room to increase rates because supply doesn't come in very easily. With our new supply, we are entering different micro markets and different cities, so it's not really going to impact our current portfolio. But there is always room to increase. And I'm seeing this whether it's in the leisure markets or in the business markets. The prices are back and demand is slowly reviving. So there is headroom for growth from an ADR perspective as well.
Got it. And speaking about growth, Nirupa, because you plan to double key count over the next few years, right? Give us more perspective as to how, that plan is shaping up for you. In terms of stabilization, also timelines, margins, what will you be expecting over a period of time? Let's say, because FY29 is still when you still go and, expand further, but you'll be also ramping up whatever you're expanding into, right? So give us more sense as to what that plan looks like.
See, currently, if you look at it, first I'll talk about the margin bit because that's something you refer to. So I'm happy to say that even in this Q1, we were able to increase our margins by about 140 basis points compared to the previous Q1 of FY26. See, currently as a portfolio, we're at 35% EBITDA margins. The ADR average is around 7,200. So considering what our ADR is, because a lot of our hotels are in tier 2 markets like Mysore, Kochi, GIFT City. So they're, pushing the ADR greater than 7,500. We are inching towards it, but that's our end goal, is to slowly push it up above 7,500 for each of the hotels. But it will take a little bit of time because, those markets are a little softer than the tier 1 markets. However, if you look at it overall, once we start developing, our hotels are getting developed as we speak, but once they start coming into the market, a lot of our portfolio is going to move to the luxury and the 5-star segment. If currently we don't have anything in the luxury segment as it is classified. We have a 5-star deluxe, one 5-star deluxe property, or in some ways it's classified as upper upscale. But our portfolio is going to shift a lot to the luxury and the high-end segment to the extent that 40% will be in luxury and another 25% will be in the five-star deluxe category. So almost 60 to 65% will move to the five-star and the luxury category. So what happens then is you will be able to increase your ADR. And the moment you start increasing your ADR, there's a flow through of at least 80 to 85% to the EBITDA.
Okay.
So when that happens, profitability increases, margins increase, EBITDA increases. So we are expecting the EBITDA to go beyond 40% when the new luxury five-star hotels come into the portfolio. So
Wow.
we are already
Okay.
starting to add to the portfolio. This year, we're adding a smaller property. It's a smaller 45 key property in Chennai as part of a mixed-use development. Next year, we should be able to add another couple of hotels to the portfolio. And 29, 30, we will start adding more. And we have 9 more hotels coming up. So we're doubling up the portfolio apart from new business development. And they will all start coming into the portfolio majority towards the end of FY29 and FY30. But we will start adding. This year, like I said, we're adding 1. Next year, we should be able to add 2. Then FY29, we'll be able to add a couple of more. So like that, we will see growth coming into the portfolio FY28 onwards.
Got. All right, so that was Nirupa Shankar of Brigade Hotel Ventures. In fact, by FY29, the premium or the luxury portfolio will go to almost 22% of the overall keys, and 30 to 40,000 average room rate is what is expected on that. So, interesting one to watch out for. The stock is almost flat, but it's time to step into a very, very short break. On the other side,